So we were founded in 2006. My background, I used to be a venture capitalist. So I worked for Apex Partners for 5 years and then for Cousin of Private Equity for another 5 years. Which was pretty useful experience both in terms of the fundraising and also, more importantly, actually just in terms of understanding what often goes wrong in small companies. I mean, every company is different and will all face different challenges, but I suppose the trick is to try and avoid as many of those mistakes or problems as you can. Dawn's background was in media, so she was in TV production, but the combination really of a bit of financial experience and a bit of marketing experience is quite a nice background in terms of being able to then take the company forward. We both liked to do some glasses of wine. I really enjoyed venture capital. It's a great job, really interesting job. But I always wanted to run my own business. The bit I enjoyed of the job was sitting on the boards of the companies that we invested in and working with them and seeing, take them through the bad times and hopefully seeing the good times at the end of it. So I always just wanted to run my own business. Our first shop in November '06 in Islington. So that was really financed by me. So I put a £150,000 director's loan in. By the way, if you're going to finance your business to begin with, do it as a loan because it's so much more tax efficient when you get it back. You don't have to pay tax twice on it, basically. And then £100,000 from HSBC secured in my house, plus no salary for 18 months, and then virtually no salary for a further 2 years. So it was financially very painful, but we sort of did it with our eyes open. I'd made a bit of money from venture capital before, and we knew it was going to be difficult. But I'd rather have financed it myself to get it to that point. I don't know the equity, rather than have to fundraise as a pure startup and take the higher dilution. Shop in Islington was financially quite successful. So we broke even on a cash basis within about 6 months, and it then continued to grow revenues at about 20 or 25% from a single site. So that's a like-for-like basis. That growth is beginning to tail off now as the company's now, that shop's now been established for probably 5 years, but it's still growing on a kind of 9 or 10% per annum, which at some stage we'll need to slow down. We were lucky we won lots of awards in the wine press. We were independent retailer of the year in pretty much all of the different, there's 4 different wine retail awards, and that always helps with the marketing side. So it came to spring 2008, so we wanted to expand, but we didn't have enough cash to do it. We were profitable on a cash flow basis, but the problem that we have in our company is that it's quite capital intensive to expand. So those machines cost about £10,000 each. We need 10 of them for the shops, plus you've got a shop fit, plus you've got pretty substantial kind of rent deposits to pay on sites. And we needed to do some work on the website in order to be able to do it's quite easy to do an e-commerce site if you've got one warehouse. It's really quite complicated to do it if you've got more than one, because we sell more than one shop. You have to have a database that's live with the stock feeds from both shops. It's actually quite complicated and quite expensive. So we needed about £300,000 per shop for the capital expense and more for the website and the e-boss system. So what did we do? We decided to use a corporate finance advisor. There are pros and cons of doing such things. It doesn't work in every situation, and I think it depends a little bit on the stage of the business as to whether it makes sense. So on the pro side, help with managing the process. Now it's just the nuts and bolts stuff. It's things like setting up meetings, making sure people get the right information at the right time, making sure people get the follow-ups are done correctly, all that kind of stuff. Help with introductions. It's pretty clear that's probably what most of the corporate financiers major on in terms of when they sell to you. Someone to talk to. So it's a pretty lonely business sometimes running a company. And it's great to get some external advice from someone who's in the market. So actually just, you will get, no matter what you go through in your funding process, you will get some problems. And being able to get as many views as possible, I think, is useful. And then help with presentations and stuff. I mean, that's just the standard kind of thing. The real advantage is that we could continue within the business actually running it. So it still takes up a huge amount of time, even if you use a corporate financier. But I didn't feel comfortable to, in effect, step out of the business for 3 or 6 months and expect that the shop as it was would continue to grow and continue to be able to buy properly and to be able to do the invoicing. It's a reasonably complicated operational business, even though it's still pretty small, because we have suppliers from all over Europe and many bills to pay and all that kind of stuff. Downside, so it costs you money. You're not going to get that for free. And it's even time consuming getting them on board. It's almost like a mini investment round in itself, getting a corporate financier on board. So you'll have lots of people who pitch to you. It's quite easy, if I'm honest, to try and work out who is any good at it. And that's basically down to what they've done in the past and who the person is, just whether you see eye to eye with them as much as anything else. But they then need to get sign off from a partner within the house that they work with. The main reason for that is that they don't want to take on the work if they don't think it's going to be successful. So we've got to persuade them basically that you've got a very good chance of being able to win the company. So we agreed a success-only fee on a percentage of raised funds. It was about 5% of the capital that we raised. That's basically, as I say here, it's more expensive if it's successful. It's basically, the vast majority of corporate finance houses will want a monthly retainer plus a success fee. That's probably fair enough. We were actually quite cash constrained at the time, so I didn't really want to pay them £2,000, £3,000 a month just for being there. Whereas we could straightforwardly afford it if we raised the money. So we negotiated a success-only deal. That again took a little bit longer than it would have done if we just signed up to the monthly retainer. They would be more willing to work for you on that basis. Importantly, we didn't bust if it wasn't successful. Yeah? So let's say, I think it cost us £35,000, £40,000 just for the corporate finance advice. If even though it had been less than that, £25,000 a retainer or something, it's still, for a company, we in effect were reinvesting all our cash in stocks that would grow. It would put the company at risk if we went through that process and then failed at the end of it. So that, for us in our situation, that was pretty important. But it was hard to negotiate. It took a bit more time. So the process from that point on, who we spoke to. So we started off speaking to smaller institutional funds. We were raising somewhere between £1 and £2 million was the hope, which is a pretty awkward amount of money. It's easier to raise, say, £300,000, £400,000 or more than £2 million. It's this whole sort of equity gap thing. And it's just simply because the institutional funds find it hard to justify less than about £2 million. If they're going to do a full due diligence process, it's quite expensive to do it. And usually, for many funds, it just doesn't make sense unless you can get up to about that kind of level. But for individuals, for business angels, that tends to be too much. £1 million tends to be quite a lot of money. So it was a slightly awkward amount. So we approached both institutional funds, venture capital trusts, and smaller normal funds, so sort of fixed life funds, and some private individuals. And we made a sort of sub-selection in that. So restaurant funders. So our business model in some ways is quite similar to restaurants. They've got big capital expenditure and then side-by-side expansion. Some wine people. There's always a risk with wine that there's always that question whether people are doing it because they like the product rather than because they actually believe in the business. And sometimes there was a bit of a risk almost on the wine side that you get people who are into it just simply because of the wine. Although, having said that, it's still money, so we decided to talk to them anyway. Retail specialists for obvious reasons, and then people that we knew from various places, from my background, from other bits and pieces. I had a preference for an institution, mainly because of this negotiation thing. The difficulty sometimes with a group of business angels is that unless you have a very strong lead, it's quite hard to do the negotiations. So you can agree something with one person and then find that it doesn't suit the other one, and then it starts all over again. And unfortunately, you as the company are likely to be on the receiving end of that. So you end up with lots of negotiations going on in effect at once, and all of them want to win their parts. And so it's very hard to actually get a good deal in the end. Part of it was just experience. I've been through it many times in my previous job, and so I was kind of comfortable with how a VC works and what that would involve on an ongoing basis, as well as the investment itself. And much more capital available. So if you can get a fund, particularly a larger fund involved, they can be there for 2 or 3 rounds in the future, and we raised £1 million to begin with. It's possible, depending on the fund, that you might, for the right opportunities, be able to raise another 5 or 10 from them in the future. So we met about a dozen or so, and a similar number of private individuals or private individual groups. And after 3 months of meetings, it does take a lot of meetings, a lot of probably pointless meetings sometimes, but you've got to kiss a lot of frogs. We had 4 serious parties. So we had 1 small institutional fund, we had 3 quite different groups of business angels, all of which would do this individually, so they were kind of in competition to each other.